really excited to meet all of you virtually and be able to share. As I was mentioning earlier, this is designed to be interactive in terms of asking questions at any time. So you can post things in the chat, or I don't know if we've turned off mics, but if we haven't, you could always just unmute and jump in. The goal is to have this be helpful to you. I did put my information in the chat. It includes my name, and I'm with Greenville Federal Credit Union, and also my phone number and email. So if you had additional questions or just wanted to discuss something specific, please reach out. So I've shared my screen, so I think everybody can see. What we were going to talk about today is banking basics and credit scores. And so really what I wanted to discuss was understanding the banking business model. And I know most of us are adults and we've had experience with banking, but it is important to understand how banks work. We'll talk a little bit about the difference between a bank and a credit union. I do work with a credit union and understand that. And then we'll segue into credit scores and specifically, what are they? How are they calculated? How do you build strong credit? And if we have time, we'll talk about some strategies to repair credit if you've made a mistake. I always like to start with memes because I just think they're funny and fun. And it says this cat looks like he has a very good credit score, which is just totally silly because he has a monocle and a top hat. But it kind of introduces the concept that you can't tell what anybody's credit score is by looking at them, right? And your credit score is not directly related to your income. And so I have known many people who have a really high income and not that strong of a credit score because they're just not managing their money to their best advantage. Conversely, I've known folks who have a more moderate income and they have a really strong credit score because they're managing their money to their best advantage. So your credit score is not something you can see on people. So I did want to talk briefly about the banking business model because it is really important to understand how a business works so that you as a consumer can take advantage of the services and also use it to your best advantage. And so banks and credit unions, we serve the purpose of giving you a safe place to deposit your money and also a safe place to be able to borrow money to purchase something that might be more expensive, right? Like a house or a car. Um, and when you think about that as a business, we are like privately held. How, and I mention that because sometimes folks think that taxes or the government somehow helps fund banking, but it doesn't. Um, we do have a lot of regulations from the government, but the main ways that as a business we earn income are related to three big areas. When you borrow money and you pay it back, you have to pay it back with interest. So interest is revenue stream for banking. When you have bank accounts and you don't follow the rules, you get a fee, right? An overdraft fee, a fee for not having the minimum balance on the account. And fee revenue is a stream of income for banking. And then another thing that's not as well known is every time you swipe your debit card or credit card, that sends an electronic signal from the vendor to the bank. So I went to Walmart, bought some groceries. It goes from Walmart to the bank. In between is a middleman called a merchant service, and they actually have to pay the bank for the privilege of working with us. So that's called interchange income, and that is something which most folks aren't aware of. But since you know these things as a consumer, you could use it to your advantage. For example, there are many checking accounts that have rewards for using your debit card, and you can understand why they're doing that. And then as a business, of course, we have expenses, right? We have payroll. We have lots of money we spend on security because you definitely want your money to be safe, whether it's physical security for our buildings or digital security to help prevent fraud. And then, if we have buildings themselves, we have all the infrastructure related to that. So it's just important to remember that banking is a business. And again, once you understand how the business functions, I think as a consumer, you could really use it to your advantage. And it does help understand why we offer the types of services that we do. So, one of the biggest reasons that you're going to want to use a bank is to keep your money safe, right? And let's say you got $100 for your birthday in cash from somebody and you put it in your pocket, you walked out and it fell out of your pocket when you got something else out and it got dropped, it's probably going to be lost, right? But the bank is a safe place to deposit your money. It's guaranteed to be there. In addition, your money is insured up to $250,000, and it's insured by either the FDIC or the NCUA, depending on if it's a credit union or a bank. Um, but you'll have peace of mind that if the bank goes out of business, which is very rare, but if that were to happen, you would get your money back through an insurance policy that the federal government does organize within a couple of days. Now, if you had more than $250,000, first of all, kudos, well done. But there are ways that you could structure it so that you could actually insure more than that. One, you don't have to deposit all of your money at the same financial institution. And in addition, you could make your bank accounts structured differently so you could have more than 250 insured. So let's say you go back to that example of you got some birthday money. And instead of putting it in your pocket and dropping it, you decided to just put it under your mattress for safekeeping and you totally forgot about it. And in 2 years from now, you decide to flip your mattress and you find it. You're going to have $100, right? But if you had deposited it into the bank, it would have been worth more because you earn interest off your deposits. The interest is called a yield. So essentially, the bank pays you to deposit money. And depending on the type of account that you choose, you can earn a higher or a lower yield, right? And so I'm going to talk about different types of bank accounts, and I think it'll help understand why they earn different yields. Um, in addition, every single bank sets their own rates, their own yields, and you can shop around and find the best one to suit your needs, right? So I think most of us know about two types of bank accounts, a checking and a savings, right? We've all heard of those. Hopefully, we all use them. Uh, Honestly, the average American has a checking account, right? Um, but there are two other types of accounts that are very popular. One is called a CD or a certificate of deposit, and the other one is a money market. I don't know what this line came from. Sorry, guys. Um, anyway, the savings account, we're using that to save money, right? When you open a savings account, you've said, I'm trying to save money. So typically, a savings account does not have a debit card attached to it, right? If you want to take money out of the savings account, you either need to have to go to the bank and get the money out in cash, or you need to use online banking and link your savings account to your checking account. And then you could transfer it into checking and then have easier ways to spend it. Because a checking account is designed for you to spend your money. When you put money in checking, we know that you're saying, I need to use this money for my everyday expenses. So to make that more convenient for you, it'll have a debit card, right? To make it simpler to pay for your purchases. When you do online banking, if you pay any of your bills digitally, they usually come out of your checking account. Back in the day, and still now, you can get checks. Most of us don't write checks anymore, but that made it easier to pay for your everyday needs without having to carry cash. So if you just think intuitively about the point of savings and a checking account, right? When you have a checking account, we as a financial institution know that you're probably going to spend a lot of the money in there. Versus your savings, you might be keeping it at the bank. And when we talked about our business model, we know that banks serve two purposes, which is to give you a really safe place to deposit your money and help it grow, right, by earning your yields. In addition, we offer lending so that people can borrow money to purchase something that's really expensive. And sorry, I wish we were slightly more interactive, but where do we get the money from when you are borrowing money? It's actually from the deposits of other people, right? So we want to encourage people to deposit money in the bank and keep it in the bank so that we have money available for lending. And if you haven't thought about this, don't freak out. I promise your money is safe. We just talked about how it's insured, right? No individual person knows if the money they have on deposit is technically out on loan. It's not individually mapped like that. But it is something to think about if you borrow money, if you don't pay it back, not only are you going to have consequences with your credit score and being able to borrow in the future, but technically you're not paying back money that somebody else deposited. The bank absolutely covers all of that, right? But then it makes it so that the bank has to earn more revenue to cover those losses. And so it just makes banking more expensive for everybody. But putting all that together and thinking about a savings and a checking account, which one, and I'll let people post in the chat, which one do you think typically earns a higher yield? Is the bank going to pay you more to put money in a savings account or a checking account? Which do you think based on our business model? Absolutely. I'm seeing savings, right? So typically a savings account has a higher yield. Not always, because sometimes there can be great rewards checking accounts, and part of that is related to the interchange income. They usually have some sort of rule where you have to swipe your debit card or a certain number of times or for a certain dollar amount. But typically, savings is going to have a higher yield than checking, right? Because the bank knows that money is available for lending. So the other two types of accounts, a CD and a money market, they are higher yields usually than a savings or a checking. And it's because there's some restrictions on them that kind of keeps the money at the bank, right? So a CD is basically a savings account with a term. You would choose the CD that suits your need. Um, most financial institutions have multiple options. Where I work, we have nine, and ours range anywhere from 90 days to 5 years. So essentially, when you deposit the money, you say, I'm going to keep it here for that amount of time. Let's say you choose the 1 year CD. You're saying, I'm not going to take this money out for 1 year. Most CDs have a minimum deposit. Where I work, it's $500. So you can only open a CD with $500 or more. And you're saying, I'm not going to take this money out before that time period. Now, if you have to use the money, it's yours, you always have access, and you had an emergency, your car had an issue, and you needed that money for repairs, you can take the money out. You're just going to get a penalty fee, right? So you always have access to your money. But a CD, often I like in the current market, has some of the highest yields because the bank knows the money is there available for lending, right? So, for example, where I work, we have a minimum deposit to open a savings account of $25. So you have to open it with $25. A checking account has no minimum deposit. A CD has a $500 minimum deposit. And out of those, the CDs have the highest rates. Again, it just depends on each bank sets their own rate. So you have infinite choices, guys, um, in terms of what is suiting your needs, right? Um, I have an example of this. One of my children, when he was home from college, he worked a summer job at a restaurant and he earned about $6,000. And where he goes to college is expensive. And so we decided we would use that money towards his tuition, but half of it we would use in the first semester and half in the second semester. And so we knew we were going to spend $3,000 kind of immediately, but the other 3,000 we needed in January, which was 5 months away. So if I had left it in my regular savings account, that earned a yield of 0.05% APY. When you see APY, it means annual percent yield for the year, right? The annual is the year. I literally just Googled what credit union has a 5% yield on a 4 month CD, and I found three. And I joined one. We deposited the money there. I couldn't choose a CD with a term that was longer than 4 months because I knew I needed to use the money and I didn't want to get a penalty. But because it had a 5% yield instead of 0.05, it was 100 times better. And so over that time period, we earned like $53 in interest as opposed to 53 cents. So you have to know the rules of the account, but it's a way for your money to earn more just by sitting there, right? And the last type of account is called a money market. And a money market is kind of a blend of a checking and a savings. Typically, a money market has a minimum balance you have to maintain. So it might be $1,000. You have to deposit $1,000. You can't go below $1,000 without a fee. And a money market often has restrictions on the number of transactions you can have a month, right? Versus your checking account, you can take money in and out as many times as you want to in a month. A money market might only be 2 times in a month. And if you take money out 3 times, you get a penalty fee. So when I say knowing the rules of the account and being able to follow them, that's what I'm talking about. Knowing, is there a minimum deposit to open it? Is there a minimum balance required to not get a fee? Is there restrictions on the number of transactions? As long as you know the rules, and you know that it suits your needs, it could be a great way to have your money work harder just by it sitting in the bank, right? And many people, many Americans only have a checking account. And as a result, they are getting the lowest yields on their money because they just don't know. In addition, if you use fintech, Chime, Cash App, Venmo, and you use that as your main banking, just know that they don't have any choices in your deposit account, right? It's just a bucket you put your money in, and they do not give you any yield. So you would never actually earn more by depositing your money into fintech. Besides the fact that fintech has a lot of fraud and they're not insured because they're not a bank, really, I think for consumers, the biggest thing you're missing out on is your money actually earning a yield by being on deposit. Any questions about deposit accounts before we move on to lending accounts?
No, ma'am.
Okay, thank you. All right, so the other reason I might use a bank is because I need to borrow money, right? So the bank is a really safe place to borrow money. And I say safe because banks and credit unions are typically going to offer you the lowest interest rate when you borrow money. You can borrow money anywhere, right? You can borrow money from your uncle, from your friend, from whatever, and they could charge you whatever interest they want to. And there are a number of lenders that we consider to be predatory lenders, which means they charge you really high interest rates. For example, a title loan or a buy here, pay here car dealership, right? If you go to buy here, pay here, Bob's car dealership, Bob is actually financing your loan. And because he's taking it out of his business's revenue, he tends to charge you a much higher interest rate, right? So, for example, they might be charging you 28% interest, where if you had gone to the bank, it might have been 10%. I think that some people use those types of lenders because their credit score is not as strong as they want it to be, and they feel like they'll get approved. In addition, a lot of people use those types of lenders because they just don't realize they have choices, right? And so that's one thing I hope you guys take away from this entire presentation is you as a consumer have a lot of choices to make your money work harder for you. Not only when you deposit it, but also when you borrow money. You can absolutely shop around and find the best rate. So when you borrow money, you have to pay back the money you borrowed, which is called the principal, and you'll pay it back with interest, which is the extra amount. and that is one of the ways that banks earn revenue. There are many types of loan amount or loan accounts. The most common that you see are for a car, a mortgage, which is a house loan, a credit card is a loan, a personal loan. And a personal loan, you just go to the bank and say, I need to borrow money for whatever. We're going to ask you because we can't let you borrow money for illegal things. But essentially, if you could prove you could pay it back, you can use it for what you want. And then a student loan is to help pay for college expenses. Out of these types of loans, which one do you guys think has the highest interest rates? You can put it in the chat.
Who
Which
had a
one's?
high
I'm sorry.
interest rate? Mm.
Is it personal? That's a good guess. I would say personal is up there, but it's not the highest. It's actually usually a credit card. Credit cards have the highest interest rate of any lending that you will ever take advantage of. Most bank credit cards have interest rates about 25%, usually in the 20s. So right now, in this current market, if you came to Greenville Federal Credit Union and you had strong credit, and we're about to talk about credit and how that makes a difference, but if you had strong credit, you could get a car loan for about 4.5%. A mortgage, and there's lots of mortgage types, but it would be somewhere between 5.25 and 7%. Credit unions tend to have the best rates. So our credit card rates, our highest rate is actually 18%. Personal loans going to be about 13%. And student loans have all this variability, whether it's backed by the federal government or it's more like a parent plus private loan. So student loans range somewhere between like 6% and 14% right now. So credit cards are definitely the highest interest rates. So I don't really want to talk about this a ton, but just know that banking is really integral to communities, right? Banks, and if you guys think about the Great Depression, when the stock market crashed and everybody freaked out about getting their money out of the bank, banks are just really important to our society. We fuel growth. We give people a place to be able to make their money grow, um, and we're really integral to society. So banks and credit unions, we offer the exact same service. We just have a different business model, right? So at a bank or a credit union, can store your money. There's lots of different types of accounts. You can create your emergency savings account. You can do online banking. We have great apps. We're insured. We have lots of rules we have to follow to keep your money safe and lots of reporting we have to do to the federal government. So we have the same services. Again, we just have a different business model. Just out of curiosity, and you can put in the chat. Anybody in here have a credit union that they bank with? You can put yes if you do. Awesome. I hope it's Greenville Federal Credit Union, but if not, you're doing a good job. All right, somebody has a bank. So I have a bank and a credit union, and really one of the biggest differences between a bank and a credit union is whether or not we issue stock. So if you have a bank account, you also want to buy stock in your bank, right? And stock is a certificate that says you own part of that business, and when that business makes profits, they have to give some of it to you. Banks issue stock. Many are publicly traded. Bank of America, Wells Fargo. You could buy their stock off of the stock market. Some are privately held, like the Bank of TR. If you want to get stock in that bank, you better marry into the family that started them. um, but because they issue stock and credit unions do not, it means that they have to create profits to be able to give dividends to those people who bought shares of stock. As a result, for a consumer, what you see is that banking costs you more. right? Because they have to charge you higher interest rates when you borrow or more fees because they have to create more revenue so that they are creating profits to give to those shareholders. Credit unions are different. We do not issue stock. And we are a not for profit, which means our goal is not to create profits. We do have to generate revenue. We have to charge you when you borrow money, right? I like to get paid, so we have expenses. Um, but because we're not for profit, our goal is not to create profits. And what you see as an individual is there's lower rates when you borrow money, less and fewer fees, and often a higher yield on your deposit accounts. Credit unions have this really cool history of social responsibility. Um, and the first credit union that was ever created was actually created by a man who was a court reporter, and this was in the 1800s. And back then, if you owed people money, you could go to jail, to prison. It was called debtor's prison. And he was recording the trial of this person who owed money to somebody, and that person was charging him 5,000% interest. And his name was Desjardins, the man who started the first credit union. And he just thought this is not right. And so people pool their money together. So it's a collaborative. Um, at a bank, anybody can deposit money and anybody can borrow money, assuming they prove they can pay it back. At a credit union, it's different. You have to become a member, and to become a member, you have to deposit money. Again, where I work, it's $25 for adults and $5 for children. So everybody has to have deposited money, and only members are allowed to take advantage of lending, which means they've already deposited money too. So it's just a collaborative kind of a feel good thing. So Greenville Federal Credit Union was actually started by Greenville County School District employees. So originally, the only people that could become members were those who worked at the school district. Every credit union has what's called an original seg, an original group that started it, and it's often a workforce. If you're familiar with MTC, they were started by Michelin employees. Truliant was started by AT&T employees. CPM was started by Charleston Paper Mill employees. So it used to be hard to become a member of a credit union because you had to work at that business or be a family member. Many credit unions have a community charter now where they can serve a broader group of folks, but that didn't become a law that they could do that until like the early 2000s. So my point of that is credit unions for an individual can serve you the same way as a bank. It's just going to cost you less to bank there um, because of our business model. There are some restrictions. If you owned a big business, credit unions tend to be smaller than banks, and so we can't lend out as much money as a big business, right? For the individual consumer, this is never going to happen. But let's say you owned a factory and you needed to borrow $100 million to build another factory line. A credit union probably can't serve you. You'd have to go to a big bank. So sometimes for businesses, banks could be a better option. But for individual consumers, credit unions really were designed to serve you with lower cost banking. Any questions?
Cover and could stop.
I'm sorry. Oh, okay. All right. Well, let's talk about, we're going to segue into credit scores. And to segue this, one thing I usually ask is who here would let me borrow their car today? I'm really having an issue. I just need to borrow your car. Put in the chat. Are you going to let me borrow your car right now, today? Yes or no? Be honest. I see a lot of no's, right? And the reason you're not going to let me borrow your car is because you don't know me, right? And as a result, you probably don't trust me because we haven't had enough interactions for me to prove to you that I'm trustworthy. If you think about this, there's probably somebody in your life that you would let borrow your car because you feel like you could trust them and it's worth the risk, right? I know there's a lot of other variables, insurance and all those things, but potential or really it just comes down to trusting, right? Now, the other thing I want to pose is let's say we were all in the same room together And I said, I really need to borrow your car to run to the store really fast. And I put $10,000 in cash on the table. And I said, when I get back, if there's anything wrong with your car, you can take the cash out of here to fix it. Would anybody then potentially be enticed to let me borrow their car if I was just running to QT to grab something? Okay. Bank that because we're going to come back to that. Potentially, yes, right? Because I eliminated some of the risk for you. All right. So a credit score is really a number that indicates how well a lender can trust you based on your past behavior. So when you've borrowed money in the past, how trustworthy were you to pay that money back? And as a result, how likely do I want to trust you if I don't know you, right? Now, all of us know that we can make mistakes in life and change our behavior. So your credit score is constantly changing based on your financial behavior. And if you've made mistakes, you can absolutely repair your credit. It just takes a little bit of time. The other thing that a credit score indicates is your capacity to pay a loan. And capacity, I think, is really well illustrated with this example. Let's say I told you I make $10,000 in a month, and I came to you and I wanted to borrow money to buy a car, and it was going to cost me $500 each month. But you knew I made 10,000. If you're saying you made 10,000, but you got to pay me back 500, you can put in the chat. Would you think that you would approve me for the loan? Yes or no? I make 10,000, I need to pay you back 500 each month. I would feel like many people might say yes, right? That's a lot more income than I need to pay back that loan. But if you found out that I also already owed for three other cars, two houses, and four credit cards, and already $9,000 of my income was spoken for, would you then want to approve me for the loan? Probably not, because you're thinking you're not going to have enough money, right? So that's what capacity is. So a FICO credit score, which is the most commonly branded credit score, is a number between 300 and 850. And the higher your number, the greater your credit worthiness and the less risk you are to the lender, right? You've proven that when you borrow money in the past, you pay it back appropriately on time and the right amounts. And so you're less risky to a lender because they're thinking, I can probably trust you based on your past behavior. It's just a quick and easy way for a lender to assess your credit worthiness. How is your credit score calculated? So this, like I said, is constantly updated based on your financial behavior. It's using a credit report. And in the credit report, it's going to have all of your credit history for the past 7 years. Anytime you've borrowed money, all of the payments that you've had, any loans that you have outstanding, right? And it's constantly updated based on your bill paying habits. It also includes all of your personal information, your social security number, your address, your name, your birthday, all those things. And there are three credit bureaus. One is called Equifax, TransUnion, and Experian. Each of them has an algorithm to calculate your score slightly different with how they weight different variables. So your score at Equifax, it's probably going to be different between the three bureaus, but it should be in kind of the same range. So let's say your score at Equifax was 720, TransUnion it was 712, and Experian it was 710. You would consider that to be in the same range, but even if it's not the exact amount. Now, if you have a company that tells you, hey, we're going to help you repair your credit, um, often they just want to pull your credit report and see if there's any inaccuracies. Is there fraud? Is there something on there that's reporting as yours that's not? Is there a misspelling on your name? You can do all of those things for free. So I would not pay somebody else to do that. How is your credit score calculated? So these are the main variables that go into your credit score: your payment history and your outstanding debt. Those are the two biggest factors. Are you making a payment on time, right? If I have to pay $250 on the 15th of the month for my car payment, am I making that payment on time every month? Anytime that you pay it late, it's recorded. Anytime that you pay it on time, it's recorded. Heads up, it's only reported to the credit bureau as late if it's 30 days late or more. So if your car payment was due on the 15th of the month and you paid it on the 27th, you might get a late fee from your bank, but they would not record that as late to the credit bureau. So you do have a little bit of a grace period there. Your outstanding debt is all of the money that you owe on loans. Your credit history, what's happened for the past 7 years, and it is recorded for 7 years. So if you have a blip and you have a mistake that happens, whether it was a life interacted or you just forgot to pay something, it is going to be recorded for 7 years. Your inquiries, every time you pull your credit, that's recorded. And then the types of credit in use. Some debt is considered more healthy than others. For example, a home loan, even though that's probably the biggest loan you have, that is considered more healthy than credit card debt, right? In part because when you own a home, you're generating equity and makes you more like stable in one place. There's a lot of different factors, but just know that different types of, when you hear like, I need a mix of my credit. Now, the one thing that you've probably noticed is we're only talking about money that we have borrowed, right? So if I'm paying a bill, but I didn't first borrow money to be able to pay it, to be able to buy the thing, it's not recorded to the credit bureau. So, what is a good credit score? So, currently, prime credit, and if you have prime credit, you will know that you will get approved for lending. You're not going to get the best rate, but you will get a very strong interest rate. Currently, prime credit is between 660 and 719. There is definitely a lot of emotions that people feel when they're applying for lending because it's embarrassing if you don't get approved. Also, too, if you're looking to borrow money, you probably need it for something. So you have a sense of urgency and need, and it just adds to the emotional stress of what's happening. So just knowing where you would get approved, know that if you have prime credit, you should expect that. These are the tiers based on FICO. Where I work, we would divide this into more tiers, probably like seven, just to make some of those ranges a little bit different. Depending on your credit score, it will also determine the interest rate when you borrow money. So if you are in the top tier, you'll know that you'll get approved and you're going to get the lowest interest rate that that financial institution offers. As you go down the tiers, the interest rate will get more expensive. And once you get into the poor tier, you will know that you're probably not going to get approved for lending. So, for example, if you were coming to Greenville Federal Credit Union to get a car loan, and you had a credit score in that top range, our interest rate is going to be 4.49%. If you were in the bottom range, and we actually cut it off at 570, so it's a little more lenient than that. But if you were between 300 and like 565, we're going to say we can't approve you. I'm sorry. If you were in the fair range, and again, we would divide that up, but if you were in the lower part of that, you're going to get our highest interest rate, which on an auto loan would be 18%. So if you borrowed $20,000 to buy a car and you were paying 4.5% interest versus 18% interest, I don't have that table in front of me, but you are going to pay about $8,000 extra in interest. So your credit score is really important for lending, not only to get approved to borrow money, but also to make sure that you're not paying back a lot more. So, for example, that I just gave you, if you borrowed $20,000 to buy a car and you were at that lower interest rate, maybe you would end up paying $1,500 in interest. So you'd end up paying back $21,500. But if you were in the lower tier and you had the highest interest rate, you might end up paying back $10,000 in interest. So you paid back $30,000. It just costs you more, right? So having your credit score as strong as it can be is helpful to get approved, helpful to get the best rates. And the other thing is, it's not only related to lending. We often think of credit scores just when we're going to borrow money, and you could potentially go your whole life and never borrow money, right? For most of us, when you want to buy a house, that's probably a lot to spend in cash, but hypothetically, you could. But there are other reasons why your credit score is used, and often your credit is pulled when you want to rent a place to live. Even though you're not borrowing money for that housing, your credit score will be pulled to see if you are going to be approved to be able to rent that space or if you have to pay extra deposits. The same thing happens with utilities. If I move and I need to turn on the power or the water, they're going to pull my credit and decide if I have to pay a deposit, right? If you have insurance for your car, your rates can be higher if you have weaker credit. Some employers pull your credit. Where I work, all of our employees, we had a credit pull before we were offered our jobs. Makes sense because we work in finance, but if we had had a particular credit score, we would not have been able to be employed here. So my point of that is your credit score is really important to nurture, not just because you have lending, but because it makes things cost more in other areas. So, how do you build good credit? I mean, looking at how your credit score is derived, the number one thing is pay your bills on time, right? And pay installments in full. So, if you borrow money for a car and you have a monthly payment of 250 and you only pay 200, you don't get partial credit. You didn't make the payment. And also, if you borrowed money to buy a car and you have to pay it back for 5 years, if you stop paying after 2 years, you don't get partial credit. It will be that you didn't pay it in full unless you made extra payments. Um, the other thing you need to do is make sure you have some bills in your name, right? This often I talk about with like students when they're trying to build their credit, but sometimes it could be if like everything is in your spouse's name. Often a credit card or a secured loan are a great way to create your credit. So for those of you who maybe are new to this country or those who have made mistakes and you want to rebuild your credit, using secured lending or a credit card is a great way to build your credit score. Um, has anybody here ever used a secured loan? I don't see any chats. So remember when I gave the example of I'm going to borrow your car, but I'm going to put $10,000 on the table in case there's a mistake? That's kind of what secured lending is. So when you do a secured loan, you typically have to deposit the money, right? So what happens is when you deposit the money, most secured loans have a very low interest rate. Where I work, it's usually 3.99%. So I am paying back with interest. But the reason I'm doing it is because every time I make that on time payment, it's recorded to the credit bureau and it will rebuild my credit or build my credit up, right? So, for example, let's say you got a tax refund, you got $1,000. You went to the bank and you said, I want to do a secured loan. You have to deposit the $1,000 in the bank and keep it there until the loan is paid off. With that example, let's say you did a 1 year term and the interest rate was that 3.99%. Each month you'll pay back, I can't do that math in my head, $83, I think. And then at the end of the year, you've paid back $1,000 plus 39.99 for the interest. But the only reason you did it is because every month that was reported to the credit bureau, and after about 6 months, you will see a huge increase in your credit score, right? Depends on all the other variables, but if that was the only thing you had, you would see your credit score go up like 100 to 150 points. And this is how a lot of people build their credit or rebuild it. It eliminates some of the risk because if you don't make the payment, then the bank is just going to take that money out of the account, right? So it helps them feel more confident that the risk is eliminated. Try not to overuse your credit. And has anybody ever heard of Experian Boost? No? Okay. Well, Experian is one of the credit bureaus. And as I mentioned, the only time things are reported to the credit bureaus is if you borrowed money and you're paying it back. It's not paying as you go. So, for example, when I pay my rent, that is not recorded to the credit bureau. Ironically, if I don't pay my rent, they will tell the credit bureau, right? So I'll get the negative impact, but not the positive. Or before they decide I can live there, they're pulling my credit to see whether or not that can happen. So there are many things that people pay as they go, such as rent, their utilities, for their cell phone, their water and power, and those things are not reported to the credit bureaus. But with a program like Experian Boost, you're asking Experian to track when you make those payments. So you typically link them to your bank account. And then when you do pay your rent, they will give you the positive impact of making an on-time payment. The only negative about Experian Boost is they don't share that information with the other two credit bureaus. So your Experian credit score could really increase, but your other ones would not. But it is a very positive program. Um, and then it lets you, like I said, record things that are not typically recorded to the credit bureaus. You can get a free credit report from any of the credit bureaus once every year, and it won't affect your credit score. So you would just contact them directly. You also can go to annualcreditreport.com and get your credit report filled. If you do the annual credit report, it will not include your score, but it will show all the details. This is really important to do to make sure that there's not ever fraud, right? If somebody stole your identity and opened an account in your name, you can absolutely fix that. Just takes a little bit of time. If you were trying to buy a car and you found that out and you needed the car urgently, it's just really frustrating for the few months and the stress to try and repair that. But this is a great way to make sure that there's nothing happening that's fraudulent. If any of you use online banking, many banks, Greenville Federal Credit Union, we have in our app, it'll show you your credit score. All of my credit cards do the same thing. And so I can always be monitoring my lines of credit. All right. Things that are reported negatively on your credit report, if you don't make a payment, right? A delinquency, like I said, it needs to be over 30 days. A charge off when you just stop making payments on something, that's reported and it's reported for 7 years. You don't pay your student loans, it's also reported for 7 years. You don't pay for your home, it's reported for 7 years. If you declare a bankruptcy, some are reported for 7 years and some for 10 years. So the point of this is if you have a life situation where a job loss or somebody's ill and you are not able to make a payment, if you would contact your creditor, they will work with you. There are lots of different programs, but if you don't contact them and you take no action at all, then they're going to tell the credit bureaus and it's going to affect your credit for a long time. And I know this is really hard because let's say you lost your job and you couldn't make the payments on your car. You're stressed out. You're emotional about it. There's, potentially fear for the future. You might be embarrassed, whatever the pieces are. You're worried about your family. There's all these emotions. And the last thing you want to do is call your creditor. But if you do take it proactively, it will really help you in the long term. And one way I kind of equate this is let's say we were all friends and we were meeting for dinner and I didn't show up. If I called you the next day and said, I'm so sorry, I had my child was really sick and I couldn't make it, you're more likely to forgive me than if you try to reach out to me and contact me over the next 6 months and I totally ignore you. And then all of a sudden I call you and I want to be hanging out again. You're probably going to be less likely, right? So I just kind of equate it to letting your lenders know if you're having a hard time making payments. So we talked about building good credit, paying your bills on time, paying the installments in full. If you use credit cards, one, if you pay off the balance each month, you won't accrue any interest. But if you do need to maintain a balance, try to keep it at 30% or less of the credit line. And you could ask for a credit line increase to help with that. If you pay off a credit card, unless you just know that you are going to overspend, um, you're going to want to keep that credit line open. Use a credit builder loan or a secured credit card, which we just talked about, or Experian Boost. Make sure you deal with your collections accounts and try not to overuse your credit. So we talked about these secured loans, right? A share secured loan usually has a very low interest rate. And the reason you're using it is not because you need the money for something, but you're using it because you want to rebuild your credit. A secured credit card is very similar. The difference is it's a revolving loan, so it doesn't have an end period versus if you did the share secured loan, you did it for 1 year. After 12 months, the money would be released. If you're using a credit card, that money stays in there until you close the card, right? But either of these is a good way to be able to build your credit. I don't know that we need to talk about debt management versus debt relief because that's a lot of information. And we're getting close to time. Does anybody have any questions or comments or thoughts about what will help you?
Yes. Hello?
Yes,
Okay. Hey, my name is Benita,
hey,
and thank you
Benita.
so much. I really appreciate you take the time and give us so much information. But my question is more about mortgage.
Okay. Yeah. What's your
So,
question
can
about the
you please
mortgage?
tell me what rate you guys have, you know, based on the credit score, the same way you did with the car loan and
Yeah, so there's a lot of different factors with mortgages. So I'm not trying to be evasive, but it's hard to give you an exact rate, right? Because mortgages, not only is it based on your credit score, but in addition, what's called your debt to income. So how much income do you have compared to how much debt you have with all of your minimum payments? So you might hear that called DTI. For most mortgages, you want the cost of your housing, so whatever your mortgage loan is going to be 30% or less of your gross income. And in addition, your total debt to income usually needs to be 45% or below. So there are other factors. The other factor is that you can do a fixed rate mortgage where the interest rate stays the same for all of the years of your loan, which for most people is 30 years. You can also do an adjustable rate mortgage called an ARM loan, where the rate can change over certain time periods. So, for example, where I work, we have fixed rate lending. I would say for most folks, and this changes regularly, but for most folks, that's going to be somewhere around 7 to 7.25%. We also do adjustable rate mortgages, which sounds scary, and you have to know the rules. But for example, we have what's called a 5-in-1. So it means that it stays the same interest rate for 5 years. And then after the 5 years, it could increase or decrease. It can adjust every year. That's what the one means. Now, where I work, we have a cap that it could never increase more than 1% in a year. Some financial institutions do not. So you'd want to make sure you knew that. But in the example of that 5-to-1, our rate might start at 5.25%. So for 5 years, it'd be at 5.25%. Year six, if the market was where rates are going up, it might go up to 6.25. In year seven, it might go up to 7.25. But if you did a fixed rate, it would have started at 7.25. So you essentially have 7 years where it would be cheaper, right? And then it actually goes to what the current market rate is. So again, you want to make sure you know from the lender because you could have a lender that doesn't have a cap on how much it can go up each year. I mean, potentially interest rates go down and it would go down, right? But there's just the risk that rates are going to keep going up. So there's just so many different variables with mortgages, but the very short answer of that is if you did fixed rate lending, I think you'd be somewhere between 7.725, depending on credit and all those debt to incomes. If you did adjustable rate, we start at 5.25. Does that answer your question, Benita?
yes, thank you.
You're welcome. And mortgages are just, there's a lot with mortgages, right? There's companies that can help. Like there's four government-backed loans at FHA, USDA, VA, and oh, of course there are all these acronyms and HUD, right? But those essentially have different rules and credit scores. And in fact, if you guys want to do a mortgage thing, I'll connect because I can give all those details just so you know. But for many of those, not only are they backed by the government, so it helps banks give the lowest rates, but they also have lower down payments you have to put because a typical down payment is 20%, right? Many of those programs have either no down payment or only 3 or 3.5%. So it just makes it a lot more doable. So, for example, the average house in Greenville County costs $300,000. If you have to put down a 20% down payment, that's $60,000. That's a lot of money, right? But if you only had to do a 3% down payment, that's $9,000. It's still a lot of money, but it's a lot more like doable than 60 for many people. In addition, there are all sorts of resources locally where different companies may have down payment assistance programs in the form of a grant. They might have rules like, hey, they're going to pay for your down payment, but if you can't sell the house for 5 years or whatever, there's all these different individual programs. So it might be cool to have a session about that so we could just talk about the local resources and just do all the information. Or you could reach out to me individually, Benita.
Okay, I will definitely.
Yeah.
Yeah.
Thank you for asking. Any other questions? All right. Oh, I thought somebody had another question, but I don't think so. Well, thank you guys so much for your time today. It was so
Thank
lovely
you.
to get to chat, and I hope this was helpful. And I look forward to collaborating again in the future.
All right.
Thank you for
Thank
the
you.
information.
Thank you so
You're
much, Sarah.
welcome.
This was great information. I've actually learned some stuff as well. So thank you so much. Great session.
Of course. And
Yes, you
please take me
did.
up to reach out, guys, if that's helpful. I try to be really friendly and accessible, so reach out.
Yes, ma'am.
All
Okay.
right.
All right. Well, this concludes our family learning meeting for today. Everyone have a great evening or afternoon, and don't hesitate to reach out to Sarah Bell as well as Infinite Possibilities. I think many of you have our contact information. I'll put it also in the chat. We also provide uh, some services for children and their families that are displaced or vulnerable to displacement. I'll put our website, our contact information in the chat. Please reach out to us if you're in need of those services as well. Okay, if no one else has anything to say or any questions or announcements, everyone please have a good day.
You too, love.
All right, thank you. Bye.